Hello and welcome to this session in which we will discuss sourcing of deduction. In the prior session, we looked at sourcing of income. Now, source of income means what? It means you need to determine whether the income is a US source or a foreign source. That's good. But also what you want to do is you want to see if you have any deduction and if those deductions are US deductions or international income deduction. So why is that important? Because deduction reduces your taxable income. Deduction reduce your taxes. So that's why you need to know whether you are a taxpayer with US or international income. You have to determine first your income. Is it US source income or a foreign source income? Then you need to apply allowable deduction. So you have your income. Then you want to know, for example, let me simplify. You have a US income, and I'm going to call it non-US, foreign income. So you have this income, okay, for both. You source them, you determine which is which. Then you're going to have a deduction. And this is what we are learning about here. The deduction that you can use to reduce your income to get to your taxable income. So this process, when we take income minus the deduction, defines the taxable income for both US and foreign sources. Now, the US taxpayer uses these deduction obviously to minimize your taxable income. They go out of their way to reduce your taxable income, specifically foreign taxable income, because you want to reduce that as well. Now, bear in mind also, computing the proper deduction will help us compute also the proper foreign tax credit, which will prevent double taxation. Remember, the foreign tax credit gives you credit for taxes you paid overseas. Now, for a non-US taxpayer, they utilize deduction to reduce their effectively connected income. What is effectively connected income? It's their business income in the US, and we'll talk about the effectively business income. So non-US taxpayers, international taxpayers, when they operate a business in the US, we call this effectively connected income, which is a business income. And we'll talk about that in a separate recording. You also want to know what are your deductions that you can use against this effectively connected income. And this is what we will discuss in this session. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. The first thing we want to learn is how to allocate, how to distribute these deductions. There are two methods, either allocation or apportionment. What is allocation? Now, allocation is the best. Why? Because if you can link the deduction directly to the income, it's great. So if you can allocate the deduction directly to the income, that's the best way to allocate the deduction to the income. You're connecting the two. For example, if a deduction for an expense related to generating foreign income, it should be allocated to that foreign source income, and that's that. That deduction is directly related to that income. Perfect. Now, how about if we cannot find a direct link? Then we have to use some sort of apportionment. What is apportionment? This involves dividing the deduction. We'll take in the total of the deduction, and we're gonna split it between US and foreign income using some method, some fair method. What could be a fair method? It could be based on sales. For example, if 40% of your sales is overseas, then you would use 40% of the deduction overseas and 60% local or domestic. And this step ensures that deductions are spread out in a way that reflect where income was earned. Now, bear in mind, we have some specific rules for some deductions, and we need to discuss those specific rules. So when it comes to US laws, certain expenses and deduction are subject to specific rules and how they should be allocated and apportioned between the US income and the foreign income. And what's the purpose of these rules? Is to make sure that the deductions are fairly distributed. You're not taking too much US deduction or too much foreign deduction. Okay. The first one we're going to look at is interest. So if you have interest expense, and you have operation overseas, you have operation in the US. How are you going to allocate this interest expense? Well, the allocation of interest expense is based on the average value of the taxpayer asset over the tax year as recorded in their accounting record. We're going to look at your book value of the asset, and we're going to allocate the income based on the average. And this method reflects the idea that interest expense tied to financing your overall operation, which makes sense. The assumption is this: you have interest because you have assets, and those assets are the reason for your interest. Therefore, what's going to happen, we're going to take the value of your asset, depending on how much value do you have, and spread the interest based on these assets, whether they are US based or foreign based. The value of the asset provide a proxy, like a measurement of how much the operation are US based versus foreign based. Let's take a look at an example to illustrate this point. Let's assume TechGlobe, a US corporation, has $30,000 in interest expense. They have US asset of $400,000, foreign asset average book value of $100,000. So notice the total is $500,000. What can we say right now? US is 80%, 40 divided by 400,000 divided by $500,000. Foreign-based asset 100 divided by 50 by $500,000 is 20%. So we'll calculate the interest expense based on this ratio. So the average total average tax book value of the asset is the sum of the foreign asset and the US asset, which is $500,000. Then we're going to divide the interest expense based on that. Well, we're going to take 30,000 times 80%, and that's going to give us 24,000. This is the amount that we will apportion, we will allocate to the US operation, to reduce the taxable income. And what's remaining? Remaining is what? Remaining is 20%. 20% times 30,000 is 6,000, and that's the amount of interest expense that we will apportion, we will allocate, we will use to reduce foreign taxable income. And this is how we do it, based on the tax book value of the asset. How about R&D, research and development? R&D must be divided using two-step process that consider first the location of the research and then the sales distribution. So if we incur research and development, how are we going to allocate this? Well, two-step process. First, we determine where is this research and development taking place, research and experimentation, research and development. Immediately in that location, 50% of the expense is allocated to that location. So initially, 50% of these expenses are allocated according to where the research actually takes place. Here we're recognizing that the costs are directly tied to a specific location. It may not be the case, but we could be doing R&D somewhere we're just doing R&D. There's no operation or sales, but nevertheless, we take 50% right there at that location. And the remaining 50%, we will say the remaining 50% we're going to distribute it based on the proportion of US sales to foreign sales. Then we're going to look at the sales, use the sales as a fair method to distribute the remaining 50%. And we assume that because R&D or R&E is benefiting the sales in the US and foreign sales. Let's take a look at this example. Let's assume we incurred $1 million in R&E or R&D, $1 million. The location of the research activities was the US, United States. What's going to happen is this: since the location is the US, half of that, which is $500,000 immediately, is allocated to the US activities. What's left is the other $500,000. The other $500,000 will be distributed based on sales, and here's what we are saying. 70% of our sales is a US sales and 30% is foreign sales. Then what we're going to do, we're going to take the remaining $500,000, allocate 70% of it is for the US. Now the US is $350 plus the initial $500,000. So in total, we're going to allocate $850 to the US operation, and the remaining, which is $500,000 times 30%, goes to the foreign against the foreign income. And this is how we allocate R&D. How about state and local taxes? Well, the state and local taxes are directly related to the jurisdiction that's being imposed at. Meaning, if a company pay income taxes to a specific US state or a specific county or a specific location, we should allocate those expenses, all of it, to that income from that location. And obviously, these rules kind of recognize the direct relationship between the income that we generate and the location in which we are generating this income. And I believe that makes sense. If you're paying state taxes in PA, it should reduce your taxes in PA, Pennsylvania. How about charitable contributions and dividend? Well, allocation to US source income. Why? Because charitable contribution, the reason why you are giving a deduction is because you are a US taxpayer. In the US, we believe charities is a civic responsibility, and this is based on US tax law. Therefore, if you make any charitable contribution, it should be used against US income. US income. Same for dividend. Dividend, especially coming from US corporation, are US sourced income. So any expense, any deduction related to that dividend should go against this. These specialized rules, what are they designed to do? They're designed to align the allocation and apportionment of the deduction with some sort of economic activity or some sort of allocation that makes sense, that's generating taxable income. To do what? To make sure you have more accurate and fair taxation process. So the deduction that are related to the US reduce your US taxable income. The deduction that are related to the foreign source income should be taken against that foreign source income. Let's take a look at this multiple choice questions from farhatlectures.com. Which of the following best describe the first step in allocating the apportioning deduction for US and foreign source income? So, what's the first step in the allocating? So, how do you do it? What's the first and best describe it? Is it distribute deductions based on the ratio of US to foreign asset? Do we do that? Do we just say, okay, let's take a look at the asset, US asset versus foreign asset? Well, we might have to do that for certain, like for example, for interest expense, we do that, specifically the tax book value. But is this the best that describe the first step in allocating? No. Allocate deduction to specific class of income to which they directly relate. Well, if we can find that, if we can somehow directly relate the deduction to the income, that's perfect. Allocate the deduction to the specific class of income to which they directly relate. That's the best and the first step. If you can find this, you go with that, because you can directly tie the deduction to the income. So this looks like a good answer. Let's look at C. Apportion deduction equally between the US and foreign source income. Now, that's kind of fair but unfair. It sounds like, yeah, it's fair, 50-50. Well, what if my US operation is only 30% or 20%? Or what if my US operation is 90%? Why am I only given it 50%? It sounds fair, but it's not fair at all. Allocate deduction based on the geographical location of the company's headquarters. Not at all. Your headquarters could be in the US and all your operation overseas. Your headquarters could be overseas and all of your operation in the US. So the best describe the first step, the first thing you do is you see, can I relate the deduction to the income? If I can, that's the perfect allocation. That's the best allocation I can use. What should you do now? You're going to go to Farhat Lectures, look at additional MCQs that's going to help you with your CPA exam, accounting courses, enrolled agent, whatever professional certification you are studying for. Invest in yourself. Good luck, study hard, and of course, stay safe.